Turning point to tipping points. So we put a paper out last year looking at ESG, the potential impact on the market, everything that it constitutes, and it's an incredibly complex piece and beast, as I'm sure you're aware. Initially it's about deciphering the acronyms. There's so many parts to it in terms of the structural frameworks that have been built over the last 20, 25 years by the UN and so forth. The new regulations in particular that are coming through in Europe is going to have a bigger impact. It already is, certainly SFRD and the EU taxonomy. And then just trying to look at this and understand it in terms of how the industry is benchmarked anyway, how ESG is benchmarked. Are the certifications that we're putting on buildings correct? Are we measuring the right things? In some cases, no. And how does this need to change? What's it going to cost? What will the impact be? So it is a big potential impact. At the heart of it, it's about reducing carbon emissions, certainly when we're looking at the E element. So 40% of emissions comes from the built environment, but 80% of existing stock should be in place by 2050. So there's a big retrofit element to what needs to happen to real estate. Current renovation rate is about 1.2 to 1.4%. So that needs to double, needs to go to 3% to hit that target. But the intensity of what needs to be done, according to the regulations that are coming out, is much, much bigger. And I'll try to put some big, broad numbers on it. It is a broad estimate, but it's frightening. 7 trillion, that's a lot of money for the built environment. You might think that's way too big. We did kick this one around quite a few times and tried to think about it, but we're talking about the whole built environment here, not just the investable universe. So the chart on the right, the bar chart at the end is owner-occupied residential. So that's clearly the biggest volume of stock in Europe, and that's what's going to cost the most to fix. That's going to come down to you and I as much as governments. Everything else is really what's going to be dealt with by the investment community, and it's a big number. This is based on, 1% of stock is A-rated in terms of EPC. There's another 40% that's about B and C rated. D to E is about 35%. Everything after that is 24%. So the worse it is, the more you've got to spend on it to get it right. Is that practical? Is it economical? Probably not, and that, I think, is where policy needs to change, but we're still talking about big numbers that need to go into it. I think, actually, it was CBRE put out a note the other day saying they've looked at the credit notes of loans going to assets and what the capex is. It's on average 25% of the value. It's a big number. So this is also something that you've got to factor in on top of all the macro conditions that are happening. Not exactly the bearer of good news, are we? But so how do you go about it? Well, buildings now are looked at in terms of whole life carbon. What's embodied and what's operational? They're interlinked, but it's about 50-50 in terms of addressing either or. Embodied is about the construction and production of the building. Operation is the energy used and the cost of doing it. There are different ways of fixing this. So if we look at a case study in the UK for an office, we want to reduce the energy usage from 220 kilowatts per hour down to 70 to make it more energy efficient. You think about the cost of doing it. If you look at the bottom, 5% of the total cost is about educating the occupier, changing the behavior, and you could actually reduce the operational carbon by about 50%. The bigger investment is in the envelope, that's 70% of the cost. Then it's the new plant, it's your BMS system. 10% would go towards LED lighting, more efficient floor plates, etc. So how you fix it, the cost that you need to put into it, or how you do it, there's a low-hanging fruit here in terms of the behavior. The building envelope is the biggest one. I just bought a house last year, sadly. Well, not sadly, but Victorian terrace, so townhouse, D-rated. I want to get it to B, and I know how much that's going to cost me to get it there, and it's all about fixing the building envelope. It's about putting external cladding on, etc. And it's going to cost me, when I think about those other costs, in line with that. So, it's something I've got to do, because with energy costs going up so much, certainly in the autumn, I want to cut that operational carbon and cost to myself. The other factor to consider is how energy is generated and what the targets are across different nations. So in some countries where there's a black border, getting towards net zero targets in terms of energy or for that country is embedded or enshrined in law. Where you don't have a black border around it, it isn't. The one that always amuses me is Belgium. It's probably one of the furthest back in terms of getting this done. But some countries up in the Nordics, they're clearly ahead of target in their target year to get to net zero. But I think what's also interesting and what's driving this and supporting this is just how much and the extent to which renewable energy is now a part of the electricity grid. And this in itself is also a factor in what you need to do with your asset to make it more net zero. If you're reliant on hydrocarbons, you will have to work that asset harder to make it more carbon compliant. Lots of countries, Norway is pretty much entirely renewable. It's a lot of hydroelectricity, as much as biomass and other things and wind. You go down to the right-hand side, it's where you're more dependent on hydrocarbons. So if there's a target to try to get to at least 35%, some countries still have some work to do. It's going to be impossible to stop reliance on hydrocarbons completely, unless you're fortunate enough to have fjords and hydroelectricity, etc. But again, there's a big move here, but there's also a clear gap for investment in infrastructure, and this energy park in Poland that I saw today, early this morning, is an interesting step in the right direction. But this clearly needs to progress to support this operational carbon part. Then we get to the embodied carbon and the cost of producing buildings that are better in that regard. Stats at the minute, and this is still early days in terms of the construction cost of delivering this, it's typically higher to get a net zero and nearly zero building, 6.2% higher construction cost than a normal good standard building. There's some research out there on the London market where it's looked at the rental achieved for A-rated buildings, it wasn't done by us, relative to, say, a C standard. The premium is about 9%, but that's at the minute. So there is an offset there in terms of you get a higher rent relative to the cost of delivering it. But as the market evolves, to what extent will that premium remain or will it erode if more and more buildings get to that point? I think the other advantage is, with lower operating costs, naturally, from running a net zero building, that's got to be factored into the rent that an occupier is prepared to pay. So you could charge higher rents in that regard, but equally, the costs for construction are set to rise and to continue to set to rise for the next 5 to 10 years at least. So that is another challenge in trying to deliver that and making it stack up economically or financially. Okay, so that's the E, which is, if you look at things like GRESB, where the mark investors down in terms of their sort of alignment to this, it's about 60% of the score that they use. 20% is the S. That is primarily about the social well-being, the productivity of buildings for consumers or for occupiers, and that's getting more and more importance. If you look at Fitwel, which examines this quite specifically, their portfolio has tripled pre-COVID. It was about 1 billion of assets square foot. They're now looking at 3 billion square foot. So COVID's really accelerated this change in terms of the wellness of buildings, of occupiers, the health, air quality, etc. That's become much more important to keep buildings functional and active. So that's also something to factor into the equation. And then again, we look at it more broadly. One of Sabina's slides about investing into low to middle income households for single let. This is a big market. This gives the indication the proportion of households per country that are all of a low income, so less than 60% of an average. Big numbers. I mean, UK is almost 40%. Almost 40% of households in the UK are low income. That's a big market. Will this grow, given the cost of living challenges that we're having? Quite possibly, yes. So this is clearly a big market to invest in. It's not just about the housing either. It's about all the other facilities, the critical things that are required to make living possible, certainly for low to middle income households, if not us all. So this is a big scope for future investment. So how prepared are investors in terms of getting towards this or getting to ESG? So in our global investor survey from end of last year, we said, is it an embedded part of your strategy? Naturally, it's a big part. 75% said yes. A few said no, interestingly. Where's the focus? The focus is clearly in EMEA, where the regulatory change is ahead of everywhere else, and it's really pushing things forward. What's your view on impact on pricing? Do you think there'll be a premium to ESG assets over other non-conforming assets? When we did this the previous year, the answer was quite definitely yes. This year, I think consensus where they think there is a premium is maybe 0 to 5%. Some are a bit more bullish, 5 to 10%. But I think what's really interesting is some think there's no difference, and some just don't know. They really don't know. And I think, honestly, I don't think everybody really does know, because it's so complex, there's so many other factors to bring into it. It's a difficult thing to try and understand, and it'll take another 12, 18 months to get to that point. And then if we look at, acceleration towards or alignment towards EU taxonomy and SFDR, my colleagues in the Dutch market did an analysis recently of investors engaged in that market, probably about 40% of the market total in terms of assets owned. What's your preparedness to SFDR alignment and EU taxonomy? So I presume most people are aware of this, the different articles 6, 8, and 9. 6 is basically not sustainable as a fund in terms of how you market or disclose it. Article 8 is, yes, there's some sustainability to it. Article 9 is very, very sustainable in terms of its focus, which can be both the E and the S. Most investors are quite focused on Article 8 and are happy and prepared that they're going to be in a position to promote their funds in that light. But 40% are non-sustainable, although 20%, half of them think in the next 12 months they'll get to this Article 8 position. But there's still a lot of regulatory ambiguity. There's a fear that they're going to overclassify their funds and then have to mark down, and that's going to knock them back quite a bit from a reputational standpoint. And just the additional reporting requirements that are going to be needed to get to this and maintain it are just huge. So a lot of it just seems very counterproductive to what's trying to be achieved in terms of reducing emissions. And then you talk about EU taxonomy. Again, some of this just don't make any sense to me. You're basically incentivized to have an asset that's EPC highly rated, ideally A. The greater the alignment you get is the better the energy quality of the building. But if you bought an asset for, say, 50, spent 15 on retrofitting it to get to that standard, the whole asset is not completely aligned. It's just what you spent on the retrofit. And again, if we've got this whole retrofit debate to happen, it's just completely counterproductive to that. So there's lots of changes that are going to happen to make this work. And in summary, this is a very challenging environment, and it's a very complex thing to manage. There's got to be more realistic, calibrated targets. There's got to be a feedback loop into policy to make this work properly for everybody to achieve what we're trying to achieve. Energy risk that's happening is definitely accelerating a lot of change in the growth of renewables and towards making assets much more carbon efficient and friendly. And clearly, there's a big potential for broader impact investing in living and everything that surrounds it. What's going to happen to pricing and values? Well, discuss. That's it. Thank you.
Great. Thanks very much.